Hello, ladies and gentlemen. This is Thomas Fross with Fross and Fross Wealth Management, where we attempt to be the antidote to the wall of worry and the pundits of pessimism. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find therein. So stocks have made a less than pleasant round trip this summer. The major indexes actually entered into bear market territory in June, as defined as a 20% or greater pullback in the market. However, they hit their bottom on June 17th, and they began quite the rally, which continued through the month of July, where the S&P was up over 9%. And then we come into August and volatility seemed to pick up a little bit, and we lost some of those gains with the S&P ending August at being down 4%. But it's good to remember that since the lows that we reached in June, the S&P 500 is still up a little over 8% from the low point. What caused this? Well, it seems like some of the more frightening scenarios have sort of lessened. That being said, we don't necessarily expect the volatility to decline. Most of us think about volatility as being a bad thing, but in reality, volatility can go up as well as down, which is a great thing for all of us to remember. So I thought we would do in this commentary is just talk a little bit about what's changed in the markets and in the economy over the summer. The inflationary pressures that the economy was facing earlier in the year, fortunately, we're beginning to see those slowly begin to decrease. And we think this has helped soften some of the market negativity and also helped consumer sentiment just a little bit. Recent company surveys and real-time indicators show that there's been an easing of some of these supply chain issues, while at the same time, consumer demand is weakened just a little bit. These factors we feel will continue to help inflation settle down, which hopefully will take a little bit of pressure off the Fed. Now, after realizing that the Fed policies that were in place were not really helping, the Fed over the summer took a much more aggressive tightening policy and completely ended the COVID era support and obviously raised rates significantly. The Fed funds rate is now at neutral, which the Fed defines as somewhere between 2.25% and 2.5%. Now, while the Fed has definitely more work to do to tame inflation, the fact is we're in much better shape than we have been. With the Fed tightening, the economy continues to slow a little bit, which can be scary, but is normal when the Fed is tightening. However, consumers and consumer spending in general, that does not really seem to be slowing down, and consumers continue to spend, which is causing the economy to show resilience that was not really expected. Remember, consumer spending makes up over 2/3 of the size of our GDP, and so as long as consumers are spending, then that helps keep our economy moving in a positive direction, despite what the Fed is doing to try to curb inflation. As always, we continue to monitor all market and economic activity and adjust our approach accordingly. However, we believe that we're well positioned to weather volatility and economic slowing, as well as to take advantage of market upturns when they come in, and that's the key. We want to be able to take advantage of the market as it recovers. If you have any questions or concerns, please don't hesitate to reach out. As always, have a wonderful day. On behalf of the Fross and Fross family, enjoy the rest of your week.